My name is Mark Fritzler. I'm the director for the TOPS program, and we're pleased, TOPS and the FSN Network are pleased to present this opportunity. We've been doing collaborative activities with Jamil Poverty Action Lab at MIT now for quite a few months, and we're pleased to have again one of the experts from that activity come and share some ideas and thoughts with us and engage in some back and forth questions. We encourage questions, of course. As most of you probably know, TOPS is an award by the Office of Food and Peace in the USA to do a couple of important things. One is to help strengthen the quality and the effectiveness of U.S. government-funded food security and nutrition programs, and secondly, to help strengthen the skills, knowledge, and abilities, capacities of the implementers who deliver those services. And in that light, is why we host events like this as an opportunity to share leading-edge information, technology, practices, and so on with the overall implementing community. And so we welcome those in the room, and we welcome our colleagues who have joined us online. So with that, I'd like to say thanks. And Abby, would you like to take it forward?
So for those of you who don't know me, I'm Abby Love. I'm the Agriculture Officer for the TOPS program. And I work for Microcredit, but as one of the consortium members under the TOPS program. And so this is the third in a series of events that we've been holding in collaboration with JPAL, specifically the Agricultural Technology Adoption Initiative, ATI, however you want to say it. And the first one was on kind of randomized evaluations, the opportunities and challenges around those. And then the next one was on evidence in agriculture related to information. How are we getting information to smallholder farmers? What's effective and what isn't related to extension? And so if you did not have a chance, how many of you were at either of those presentations? Can I see a show of hands? Great. So we have about half in the room. We're at least one of those. Just to give you a little context. And then if you have not had a chance to hear those, they are available on the FSNnetwork.org. You can listen to the recording. And those were put on by Kyle Murphy, who's the policy manager for ATI and JPAL. But today, we are lucky to have Becca Toole in the room with us. And so she is the policy associate at JPAL Global, which is based at MIT. And she helps manage the ATI portfolio. So part of her role is synthesizing and communicating research findings to practitioners and policymakers, which is why we've invited her to come here and share findings around credit for smallholder farmers. What kind of evidence do we have related to these types of activities? So with that, I will pass it over to Becca. Good morning, everyone. Thanks. Very close to the mic. Very close to the mic.
The microphone is right up there.
Perfect.
So if you could just project
the up there. Great. I can do that. Okay, well, thank you so much for joining us today, and thank you to our online participants. I'm really excited to be here to talk about credit for smallholders. Given that many of you are already familiar with JPAL and ATI, I'll try to move pretty quickly just through the introduction to who we are and what we do, but I will spend a little bit of time just going into our approach because I think it's an interesting way to think about the challenges that smallholders face to adopting potentially profitable technologies. And of course, we'll go into how does credit play into technology adoption, what kind of constraints, what kind of barriers might a credit constraint pose to farmers, and we'll think about adapting the microfinance model as a way to alleviate these constraints. Think about whether that is really a realistic solution to the problem of credit constraints. So I'll share a couple different evaluations that JPAL affiliates have conducted and touch upon how these have been effective in increasing both take-up of credit by smallholders and changing some of their production decisions. To close, I'll just touch on a few evaluations that look at digital financial services for smallholders, since this is an exciting area. These will be largely ongoing studies. And then I'll just wrap up with some of our emerging insights on this literature as a whole. So as Abby mentioned, I work at JPAL Global. We're based at MIT. We also have 6 regional offices based around the world.
JPEL's mission is to ensure that programs and policies are informed by scientific evidence. We do this through three main activities. Our network of affiliated professors, who are largely economists, not agronomists for the record, conduct rigorous evaluations, RCTs, randomized evaluations, of programs and policies across 8 areas, one of which is agriculture. In the policy group, which is where I sit, our role is to make sure that these research results are communicated effectively to policymakers so that they can really act on what we're learning, and we also make sure to distill these findings into clear policy lessons, so we're not looking at just the results of one study, but across the body of literature. And then our third main activity involves capacity building, so making sure that these policymakers and program implementers are both good consumers of evidence, but also potentially prepared to generate evidence themselves. So moving back to agriculture, we have about 75 evaluations in this area, most of which are concentrated in sub-Saharan Africa and South Asia. That's largely due to ATTI, or the Agricultural Technology Adoption Initiative. This is a vehicle for funding research in what we felt was a under-researched area, barriers to adoption by smallholders. So to date, we funded 48 projects across 15 countries. And this is the layout here. And since those projects took start, in 2009 was the earliest, we count over 110,000 farmers who have been surveyed through ATTI projects, so a lot of data coming in. And we count about 18,000 of those whose behavior has changed as a result of these evaluations. Now, to get to our approach and really think about how we're thinking about these questions, I want to just start with this figure that looks at cereal yields over time, so about the last 50 years. And there's sort of two things to note here. We see a lot of growth in the U.S. and East Asia as a region. And unfortunately, what we see is in our geographic regions of interest, South Asia and Sub-Saharan Africa, we don't see the same growth in yields. Particularly Sub-Saharan Africa, though starting at the same level as South Asia, just hasn't really grown in productivity as much as perhaps we would like it to. Let's compare this now with fertilizer use, which, as I'm sure you're all aware, is one input that, when used correctly, has been shown to improve productivity. And there's sort of two things I want us all to take away from this figure when juxtaposed with the graph of cereal yields. The first is Sub-Saharan Africa, which we see is very flat in their use of fertilizer over this time period. So I think the question here really is, why aren't farmers adopting this potentially profitable technology? We see this low growth in fertilizer being somewhat mirrored by these low growth in yields. But let's think now about South Asia, where we see an immense increase in the amount of fertilizer use that these farmers are applying. But we don't see that same explosive growth in yields for this region. And so this might be an issue of misapplication or incorrect use of this input, and so we naturally also ask what is keeping these farmers from using this technology effectively? So the larger question which ATTI seeks to answer is, what's hampering technology adoption, or what is keeping farmers from adopting those technologies which would be profitable for them? And we really think about this profitability framework as an important determinant for thinking about decisions around technology adoption. So we have 7 constraints. These are theoretical barriers that were identified at the start of ATTI as sort of an organizational framework for thinking about what we can do to help farmers adopt technologies. Of these 7, we have more information on 4 of them. So we think about credit markets a lot, and of course we'll talk about that for the rest of today. Under risk markets, we're thinking about both looking at products that can help farmers reduce their risk, like insurance, but also ways to structurally reduce risk in the system, like drought tolerances, flood tolerances, et cetera. Information, if you were present for Kyle's presentation, then you know how we think about that, but we're thinking about how do you make standard extension more effective, but also thinking about things like price information and how that might change farmers' production decisions. And then input-output markets is maybe our smallest of the 4 where we have a good amount to say, and that's thinking about both how do farmers get access to inputs that they need to apply, do they get them in a timely manner, as well as how do they get their produce out to market, so are they well connected to traders and output markets. Environmental externalities, labor and land, we have less to say. They're rather hard to study, but we're excited about looking for more ways to generate evidence on that. So turning to credit, first I thought we'd start off just by thinking about, from your organization or in your position, what sort of microcredit products or activities are you offering to smallholders, just so I have a sense of what you might be working on. Is anyone offering a specific product or service?
I don't think any of us are directly providing financial services.
Okay.
We do, in many of our projects, start with community-based, savings and lending groups, and then link them up to form, financial services, cooperatives or MFIs or banks if they're there. So that's the model.
Great. Is that everyone largely? Okay. Well, then we'll start by just talking about the traditional microfinance model in general. This is probably a concept that many of you are familiar with, but just to get the ball rolling and thinking about what this means, and then thinking about how it could or could not serve farmers, I thought we'd maybe start by just generating some ideas of what we think about around microfinance in general. What are some characteristics that you associate with this type of approach to credit?
Group-based, short cycle credit.
Yeah, absolutely. And who do we think about as the clients typically?
Often women.
Yeah, and I think MFIs tend to make a big deal out of that, thinking about this as a channel for empowerment, and this is a group that might otherwise be left out of traditional credit markets. Any other thoughts? Yeah, so aimed at business investment, encouraging entrepreneurship. And I think about them traditionally also as being in rural markets, urban markets among the urban poor. And so, right, we just touched on this briefly, the theory of change that most people posit is that by offering these small loans, we can encourage these women, these entrepreneurs to invest more in their businesses, and that will have these positive impacts on their business activity. There'll be higher sales, higher profits, and then this might have downstream effects also on their consumption, their social well-being, perhaps their children's education, and their empowerment in general. So the question is, does the theory of change hold up? Well, the experimental literature says not in the transformative way that microfinance is often being hailed as. What we've seen from a number of randomized evaluations that largely came out around 2015, so a couple years old now, that demand was actually more modest, first of all, than many people thought. So I think microfinance was for a long time seen as something that a large majority of people would want. But what these 7 RCTs found is that among eligible customers in new areas that had not been served by microfinance before, that take-up was only about 13 to 30%.
Where were those RCTs conducted?
They were conducted, it's a great question, across regional. So I know one was in Ethiopia, one was in Mali, one was in India, one was in Bangladesh. So both really the target areas that we're talking about, the sub-Saharan Africa and South Asia. There might have also been one in Latin America, I believe in Colombia.
How do you measure take-up?
Great question. So take-up here is we're thinking about how many people, when they receive a loan offer, say, yes, I would like to take up that loan and actually take it out. So it's truly sort of the revealed preference. If you're offered a loan, do you say, yes, I would like that? And again, these were, I just want to underscore why we say that this is modest demand. This was not offering a credit product to people who already had other microcredit models. It wasn't, trying to crowd out the market. These were people who often had no other source of credit. These funds were devoted to business activity. We did see that people were using it for that purpose, but we just didn't see these, again, transformative. But despite what we consider limited social impact, of course, there are self-sustaining, thriving microcredit markets for these urban female customers. And so even if we don't see these transformative impacts, there seems to be some sort of benefit both to the lender and to the borrower. So lenders seem to find it profitable enough to lend, and borrowers seem to take it out, so there must be some benefit to them. Perhaps it's consumption. There has been some evidence showing that microfinance loans help people to smooth their consumption. Okay, so thinking about what we just talked about around microcredit, some distinguishing characteristics, just want to what do you think about applying this model to smallholders? Does it seem like a good fit? Does it seem like they have the similar credit needs or not?
One of the big issues has been timing.
Mm-hmm.
You know, just the payback periods and so on.
Mm-hmm. Yeah, absolutely. Right. It's
Could,
hard.
could you repeat that?
Sure. For the micro, sure. So one difference between traditional microcredit customers and agriculture borrowers might be that the traditional repayment model of rapid, quick cycles of repayment might not be well suited for farmers. Of course, they have lumpy income. Their income's largely coming around harvest. So this idea of paying back every week or every month might be constraining to smallholders, certainly.
Would it also have something, some effect around the size of the loans? Because if you're a farmer and you need to take out a loan for inputs,
Mm-hmm.
and even hiring labor, if you're even a little bit more larger small farmer, it might typically be a larger amount you might need to borrow than one of your urban microfinance operations.
Yeah, absolutely. And I think also thinking about taking out money for labor or for inputs, those are needed at a specific time, so you can't really wait for your turn also to come around for when you take out your loan.
Maybe rural credit programs suffer a little bit from the dispersal geographically and lack of concentrated collections of people that you find in urban settings, which complicates both on the recipients and the lenders. Yeah.
Absolutely. The administrative costs of going out to these rural areas to collect from farmers is much, and they're more dispersed, and it's harder to come together in a lending group. Yeah, absolutely.
I think the risk component, I know that's a different presentation altogether, but if you take out a loan and then there's a drought and you don't have any insurance, how do you pay back?
Yeah, absolutely. And we think about group liability here working well, and that all the members in a traditional microfinance group they insure each other, right, through joint liability. But when you think about the risks that farmers are facing, it's not that their small entrepreneurial venture will fail, it's that they might have a pest or a weather risk, and those are going to affect everyone. So it's not just one person defaulting on the loan, it's these aggregate risks that really put the sustainability of these arrangements at stake. Yes, absolutely. So you're all right. I feel like I don't even need to give this presentation. Agricultural credit is different. We've seen very few self-sustaining agricultural credit markets emerge, and we've just talked a bit about how the traditional microfinance model might not be appropriate, and there can be difficulties in transplanting it in agriculture. There's also few agricultural-specific products available. It seems that banks, in the absence of any other sort of encouragement, don't seem to like to lend to these type of borrowers, and we'll get into that a little bit about what sort of an agricultural-specific product would look like.
Just another point. I mean, if you're doing this research, clearly smallholder farmers in the rural areas will borrow. I would think. I think that there is a practice of borrowing. Generally, that would be coming from what we might call traditional sources. Mm-hmm. And did you find in your research that there was borrowing going on, but it was going on in models that were quite different, perhaps, than what we're used to seeing in these microcredit programs? And
yeah.
Who were the lenders, and what were the rates of interest, things like that?
Yeah, absolutely. I can't speak to the sort of rates of interest among less formal credit arrangements, but certainly we do see that farmers borrow from friends, they borrow from family members. We'll actually talk a little bit about how some of these more formal credit interventions displace some of that, and we can talk about how that might be a good thing or a bad thing. But yeah, I can't think off the top of my head sort of what the rates of lending are.
Oh, sure, no, that's
normally, but yeah, it's a great point. Right, so that's a good distinction that we're talking sort of more about these more formal products and not just me lending to, I would say. Okay, great. So we've touched on these a little bit already, but just to sort of show you a preview of the policy lessons and give away everything that I'm about to say. We talked about how farmers' credit needs are different from microcredit customers in urban areas. We'll talk a little bit more about take-up challenges and how these might be low and why. As I mentioned, I'll go through a couple different examples of successful credit interventions, successful as defined by increasing. Is that me? I'm so sorry.
No, We sent for a mic.
We sent for a mic to try to hear a little bit because it's hard to hear.
Okay, I'll try to project a little more too. So these credit interventions that were successful in increasing take-up among smallholders and also changing their production decisions have done a couple things like reducing risk on the lender side, to increase the supply of credit, but also to address really specific needs of farmers like the seasonal variation that they face in income and prices, addressing their collateral concerns, and so on. And then, not to negate the value of this presentation, but what we find is that while credit constraints exist, they might not be the primary barrier to increasing profitability. So we can talk a little bit about what might need to be relaxed or changed alongside credit and what actually might be sort of what we call the dominant constraint for credit. Okay, great. So we'll just jump back a little bit to thinking about why credit constraints matter at all for farmers and why they might experience these credit constraints. I think we already touched on this idea of formal credit is what I'm implying here, that banks really don't like to necessarily lend to the agricultural sector for several of the reasons we mentioned. It's higher risk and lower return. The borrowers are dispersed, and so there's high admin costs. You can also think about the lack of credit history of risk makes lending to farmers more risky for banks. But in the absence of credit, we know that farmers could face a hard time investing in technologies like improved seeds or fertilizers or larger investments, mechanization or irrigation systems. This could be alleviated by saving, but we know that farmers really struggle to save, as many of us do, particularly because their income is very lumpy and occurs at harvest time. Another constraint around credit is the idea of collateral. Here, we have many self-collateralizing assets like our houses, our cars. For farmers, sometimes lenders demand land as collateral, but you can imagine that that's really risky for farmers. If they were to default and lose their land, then they're losing essentially their source of livelihood. Or for those non-landholder, just laboring farmers, then that also is not an option. They don't have the land to put as collateral. Another aspect of credit constraints, which I won't really touch on, is that farmers might lack the financial literacy to feel comfortable taking out a loan and to be able to look at the options that are available to them and think about do they meet their needs. But we won't really talk about that today.
In terms of constraints also, there's the political dimension as well in terms of constraints to credit. And in the collateral one, for example, I noticed that you were doing some studies in Mozambique, and Mozambique certainly isn't the only one. But there is no private ownership of land. The land is owned by the state, and you just lease it or you just squat on it. And so there's no collateral on that land. So
right.
There's a constraint right there.
Right, so there's either no collateral or perhaps the collateral that is available is unacceptable or really not appealing to farmers.
It's not fungible.
Yeah,
and
absolutely.
Another area, and this is that you're doing studies in South Asia, where I've got significant experience in the political component, there has been a lot of State Bank of India, and many banks in India, to loan to farmers, particularly to buy pump sets so they can pump water. And then during a political campaign, one of the leading political parties, running for office, the state minister, for example, who promised, if elected, I will waive all outstanding loans, and I'll wipe the slate. And so banks end up being burned, and so they don't lend.
Right, absolutely.
Because the next politician could come along and wipe out those debts. So there's another big issue in South Asia. Certainly, I'm not sure how that has happened or if it's happened in sub-Saharan Africa, but I'm sure it was.
Yeah, absolutely. I think that there's a lot of sort of market failures that go along, or political factors that go along with these constraints. Okay, so I think we touched on this, but we'll just sort of repeat what we said, or maybe we didn't a little bit, but when we think about the uniqueness of farmers' credit needs, there's things about the agricultural production cycle that, of course, are going to affect how farmers want to borrow and how they approach repayment. So one factor that I think is important to keep in mind when we're thinking about smallholder credit is this negative correlation of production and prices. These farmers are often operating in shallow markets in which an increase in production causes prices to fall. I probably don't need to tell you that in some African grain markets, the price changes can be 100% over a year. So that's hard for farmers in terms of repayment because say they have to repay their loan right after harvest, and they want to sell their grain, well, they're having to sell it at the lowest price when the market's totally flooded by supply. That's something to keep in mind, that we might need to be sensitive to when the repayment is due and what the market conditions are during that time.
That's the bitter product opportunity.
Yeah, absolutely. Again, why am I giving this presentation here? That's great. Yeah, we'll definitely talk about that. Question from online?
Yeah, so there's a question and comment from online, from Claude, and he says, what are your thoughts on like crop insurance for increased access to loans?
Increased access to loans, sure. So to give away the punchline, sort of how we think about weather index insurance, which is something we talk about a lot when we think about risk, we haven't seen a high demand for insurance. Farmers don't seem to want to pay market prices. They'll certainly take it up when given it for free. There's more take up when it's really cheap, but it doesn't seem to be that there's a commercial market for weather index insurance the way it's designed now, thinking about having a weather station measure the yields, and so of course there's basis risk involved. There's been some work, but I think there's a direction for future research in bundling these insurance products with credit. And we'll talk more about this at the end, so maybe I can punt that just for a little bit and certainly return to it. But there's definitely ongoing work and interest in the idea of can we bundle these two products together and simultaneously address both risk constraints and credit constraints. Is there a second part of that question? I'll certainly return to it. Okay, great. Well, we already touched on the aggregate risks, the idea that all farmers might be subject to the same weather conditions or pests, et cetera. So again, that's concerning potentially for the lender. And then I also want to get into a little bit of this idea of seasonal cycles to production and prices. So this probably is a familiar concept to you. What we think of when we see cash flows for farmers is that they have income coming in large amounts right after harvest, so once or twice a year depending on the growing conditions and what they're growing. And this is difficult because these income flows are not always well timed with expenditures, both on the production side and on the consumption side. So when farmers really need to, this is getting back to Mark's point, really need to make those payments for inputs and for labor, that can be several months after the harvest. And unless farmers have saved with sufficient foresight, they might have exhausted their savings at this point and might not have the cash that they need in order to make these investments. So it's hard for them to expend for the sake of production at this time. And then on the consumption side, we might worry about what this means for farmers' food stores. If they're having to sell off their production right after harvest in order to meet pressing expenditures, then they're selling again when the prices tend to be lowest. And then later, they're forced to buy if they've exhausted their grain stores when prices are highest. And so that's this misalignment in a sense of the expenditures that farmers need to make or need to avoiding meaning avoiding buying grain when the prices are really high, and how this looks with income. So this is just an important thing, I think, to keep in mind as we're thinking about the timing of loans and how we design these specific credit products. Okay. So again, we got to this a little bit, but for these reasons that we just mentioned, take-up has been low. These are some examples here, again, with mostly areas where this was the only credit product in town, or was a new credit product. So for instance, in Morocco, where take-up was only 17%, there were no other lenders. So this was pretty much the only option, and less than 20% of people took it up. Sierra Leone, take-up rates for a palm oil storage loan, that's what this was a little bit higher, but thinking about, again, lenders' constraints here, it was about half of what it needed to be at a break-even rate. So this wasn't a profitable solution in the market. And then Mali, just another example of low take-up. So this is, and I bring this up mostly because it's, again, both problematic for the lender, but also for the evaluator. From a lender's perspective, if there's low take-up, then yeah, there's admin costs that go along with that. It makes it more expensive. And then from an evaluator's perspective, this is problematic because it decreases our sample size. So it's harder for us to look at effects of credit on these downstream outcomes like profits. It's one thing to look up take-up, but then it's harder to get at these statistically significant effects for some of these other outcomes that we really care about in terms of farmer well-being. So if at some point I say we haven't been able to measure impacts on profits or yields, it's really partially driven by this low take-up. Okay, but how can we make credit work? How can we increase these take-up rates? How can we make sure that that actually works for farmers? This audience is wonderful and has already brought up a lot of ideas. The first one I'll talk about is aiming at reducing risk for lenders, and it's thinking about how do we get more information to these financial institutions that are lending so that they're more willing to lend to an agricultural consumer, and they're able to give that at better rates. So it's, as I'm sure we're all aware, in many of these contexts, there's not a lot of borrower identification. And so what this means is that a farmer could go, without any ID, could go borrow and then default on the loan, and there's not necessarily consequences. So then they could turn around and go to another lender and not have that negative consequence of default really show up in the terms that they're offered. This makes banks very nervous to lend because they don't have a way to assess the default risk always beforehand, and so then they drive up their interest rate terms in order to account for this. So maybe one way to get banks to lend to farmers at a better rate would be to give them more information. This evaluation was actually done with a paprika company called Cheetah Paprika, and the people who were offered these loans were contract farmers with Cheetah Paprika. And the structure of the loan was an input package of fertilizers prior to the planting season, and then the repayment occurred through the harvest. So it was through this contract farming organization that this was taking place. And what happened in this evaluation is after all these farmers had applied for the loans and were eligible, they were randomly assigned to two groups, one of whom got fingerprinted, one of whom didn't. So fingerprinting was supposed to address this concern of a lack of lender or of borrower identification. Of course, in the absence of bad things happening to your finger, your fingerprint can't be stolen, it can't be counterfeited, it can't be lost. So it could be a really concrete way of identifying a borrower. And this was, again, hoping to alleviate risk for the lender by, I know who this borrower is, and then you can tell the borrower, if you don't pay, I will not lend to you again. And if you do repay, then perhaps I can give you a lower interest rate the next time. So there's sort of an exchange of how this could be mutually beneficial. So first of all, what happened is it was very effective in reducing overall default rates for those borrowers who were particularly risky. And this risk prediction was based on a number of characteristics that the researchers constructed during the baseline survey. So this was for predicted risky behavior. So it reduced their risk of default by 41%. And then this figure here goes along with this, and it shows the balance that these farmers owed 2 weeks after the loan was due. So this is the outstanding balance. The only statistically significant result here was for, again, these very, very high-risk borrowers. So there weren't any changes to, so it might look like it, there weren't any statistically significant changes in the outstanding balances for these non-risky borrowers. So it wasn't affecting them. But it was helping the bank avoid these particularly risky borrowers who took out large loans typically and then didn't repay them. And the reason why there's so much of a difference here is not just that the high-risk borrowers took out smaller loans, which they did because then they said, oh, I actually will have to pay this back, or they anticipated having to pay it back, so they reduced the loan size that they wanted. But they also ended up devoting more input, more time, and more land to paprika. So this contract farming, this contract paprika business was concerned about side selling. They were concerned that they were going to give people a fertilizer, an input loan fertilizer, but then the farmers were actually going to go use it on another crop. But what they saw was that with the fingerprinting, it actually encouraged farmers to devote more investment to their paprika crop, which is how they were going to repay the loan. Does that make sense? And so this was an effective. Go ahead. No, these are outstanding balances. So this was 2 weeks after the loan was due. How much was this paprika company still owed? So people were still keeping outstanding balances. It certainly didn't reduce it to zero, and it didn't reduce the default rate after 2 months to 0. It was still in the teens. They reduced it by 10%.
How was risk?
Risk here? For whom?
For the borrower.
Oh, risk was predicted, yeah, absolutely. So it was basically at the beginning of the evaluation, there was a lot of data collected on these farmers, and they asked about their previous borrowing habits. They asked about other sort of personal characteristics, and they used it to predict it. So this is, again, ex ante. It's before the program. It's not, and it's a best guess, and there's certainly error. But this idea of predicting the riskiness of a borrower is actually getting traction in a lot of different markets. There are Ideas 42, for instance, is an organization that's really pushing this forward. So the idea is there, but I don't know exactly like what the regression was that they calculated.
So it wasn't based on previous data on repayment rates, but more on other characteristics.
It was a combination of both, I believe. But it was, yeah. But again, they didn't have these great records to say who actually repaid much. So after this, Cheetah Paprika then continued to fingerprint their borrowers, and also these results were informative to the Central Bank of Malawi, where this took place, to adopt a fingerprinting program overall as well. Question?
Yeah, so Claude, if I misstate your question, please let me know. Because so he asked, how will this fingerprinting compare to the farmer co-op model?
How will it compare to the farmer co-op model? I'm not sure.
Yeah, so if when he types in more,
Okay.
a little bit more.
Okay.
I wasn't sure if people knew about that or.
Yeah, I'm sorry, I'm not.
Okay.
Okay, so now we're thinking about more on this is both on the lender and the demand side, or the lender side and the borrower side. So both thinking about supply and demand. We talked about how land might be an unacceptable form of collateral. There might not be any collateral available, but the idea of flexible collateral is appealing because it can help farmers, it can increase access to these large agricultural investments. And so the idea is much like a car or a house in a context like here in the United States, these can be self-collateralizing. So the idea is that if you default on your loan, then your lender can repossess that asset. I'm sure we're all familiar with it. Another potential source of collateral could also be warehoused grain. And so this helps deal with the loss aversion that farmers may have towards their land, and it also helps banks take back or recoup some of their losses on the loan. This is a really neat example. This is one of my favorite evaluations that we did actually, which was looking at rainwater tanks for cattle in Kenya. So you might be familiar with this type of investment, but it could be good both for the health of the cattle in terms of ensuring them a consistent water supply. It could also be good for the farmer because then if their water is in a central place, they don't have to spend as much time taking their cows to get water. So there's a lot of benefits on multiple sides. Healthier cows, of course, mean more milk production. So there really could be a stream of impacts. But these tanks are pretty expensive. They're about 20% of the household's annual consumption, $320 US. And the SACO, who was interested in offering these tanks to their clients, had traditionally offered them with a 100% secured term. So basically, the farmer had to have enough cash to buy the tank outright. They didn't need to buy it right away. They didn't need to be able to give those $320 to the SACO right away, but they had to have it. So you can imagine that that's pretty stringent borrowing terms and wasn't all that appealing to the farmer. So they randomly, in the partnership with the SACO, the researchers randomly introduced 3 other loan terms that were less stringent. So the first one was only asking for a 25% deposit and using the tank again as collateral for the rest of the loan. The second less stringent term was only a 4% deposit, and you needed a 21% pledge from a guarantor, and again, use the tank as collateral. So it was, I put up 4% of the cash, my friend puts up, says that she will be liable for the other 21%, and then we use the tank as collateral. And then the least stringent term was 4%. So all I needed was 4% of the total amount of the tank to get a 4% of the total value of the tank to get it. So I think we should stop here and think about why a bank would not offer these less stringent terms in the first place, if anyone can think of a reason. Yeah, certainly. Right. So either you offer less stringent terms and people default more, and then either you do get the tank back or you don't get the tank back. So you might attract more risky borrowers who default. If you can't repossess the tank, then you are incurring a significant loss. If you do possess the tank, you could end up with a ton of water tanks and not be able to resell them potentially. So it certainly was some risk on the part of the SACO. I think what was interesting here is, again, it kind of follows this cheetah paprika model that I mentioned, where the repayment was taken from the milk sale. So this is an interesting way of bundling a credit product into an existing relationship that these farmers had with this SACO. The good news is there weren't a lot of tanks sitting around. The less stringent offers increased take-up, but without harming the profits for the lender. So we can compare these rates in take-up. So these are the number of farmers who actually got a tank, and we see that in the most strict loan terms, it's 100% cash collateralized loan, which is the standard terms the SACO offered. Take-up was very, very low, but it increased to 44% with a 40% deposit rate. What I think is amazing here is that these three arms, the 100% cash collateralized, the 25% deposit, and the 4% deposit with a guarantor, there were no defaults at all. The only defaults occurred in the least stringent arm, and it was less than 1%. And the SACO was able to repossess that tank and sold it without any losses. It was great. And so based on this, the SACO said this is wonderful, and now they offer these water tanks on the terms with the 4% deposit and the 21% guarantor plus a small application fee. So they saw benefit to this, the relaxing of these credit terms, and are now continuing to offer it. In terms of real impacts on outcomes, we weren't able to pick up statistically significant effects around milk production or farmer profits, but there were real changes in time use. So girls spent about 3 minutes less a day fetching water, which adds up over time. Boys spent about 10 minutes less per day tending livestock, so again, freeing up time. And girls' school enrollment increased from a very high rate already of 95% to 99%. So even though perhaps they weren't spending that much time fetching water each day, or that only decreased a little, there were real changes in school enrollment rates, which I think is exciting. And this continues. I am happy to talk about this more, but I'll just skim over it. But JPAL Africa is working to scale up this both in Kenya and Rwanda. I'm happy to talk about that more later if that's interesting to people. Okay, so moving on, this next evaluation will also sort of touch on collateral, but another way that we've seen be effective in increasing credit available to smallholders is, again, accounting for the seasonal distribution of income. So when we think about designing products for seasonality, there's a couple things we can do. We can delay the repayment of the loan until after harvest rather than before. And maybe I'll see what other people think also here. If anyone has any other ideas for how you might tweak a microcredit product to account for seasonality in terms of repayment or in terms of just timing.
What's the repayment?
Well, then you're speaking to the mic.
I guess one of the challenges with the regular microcredit is the regular payment. So if you make it a bullet loan of some sort, that may be.
Yeah, and also thinking about what are we actually trying to get people to take out loans for. So we might want to
need to hold the mic a little closer because we need to be able to hear on the online.
We might also think about, given that seasonality is a challenge, not just asking regular repayment and expecting them to invest in businesses, but thinking about maybe offering them loans for certain times of the year when they really need them the most, like the hungry season. So having consumption loans which let farmers hold on to their grain until prices are lower and finance present consumption through the loan. Or one that I thought of. Any other ideas? We can also think about storage loans. So we'll get into this idea of temporal arbitrage, which sounds very sneaky in my mind, but it's this idea that you, again, help farmers take out credit so that they can choose to store their credit when they want to and then sell it to take advantage of higher prices. So not just financing present consumption, but actually looking forward to thinking about how they can increase their profits just by holding onto their grain and deciding when or when not to sell. And we can also think about savings products that have these same goals. Any sort of these characteristics of savings products that help with smoothing these gaps in income. Okay, so this, and again, now I feel foolish because I already said that the water tanks was my favorite, but this might actually be my favorite. This was a randomized evaluation in Kenya with One Acre Fund, who you may be familiar with. So One Acre Fund offered these harvest time loans to their existing clients. They were expected to use their grain as collateral, and the grain was tagged with a certain One Acre Fund logo to say this is grain that's going to be collateral and I won't sell it. And then they had 9 months to repay the loan. And so it was exciting because these loans did help farmers store their maize, so they kept it while prices were low right after harvest, and then they stored as prices rose, and then they sold later at higher prices. So just by having that loan to finance their present consumption or any of their other expenditure needs during that post-harvest time, they were able to take advantage of temporal arbitrage, which increased profits. And I think what's interesting here is to think about the general equilibrium effects, which we don't know a whole lot about here. So what we see is that in areas where fewer farmers were offered these loans, this was part of the evaluation design where in some areas a lot of farmers were offered loans and some areas only a few were, the profit increases were bigger for these areas where fewer farmers were offered loans, suggesting that they were better able to take advantage of these temporal arbitrage ideas where they're waiting for the highest prices and selling them. But on the other side, if you're offering it to everyone, that might be helpful because it might smooth market prices. And so there could actually be more widespread effects for both farmers who do and do not get loans if by having people hold grain, being able to hold grain could smooth the prices overall. There's not research on that yet. That's where I think things are headed, and people are excited to think about that because we don't just want to make things better for these select farmers who chose to take out the loans and take advantage of temporal arbitrage. We'd really like to see it smoother prices overall for everyone. So that's going to hopefully happen at a later date, and it's exciting to see where that's going to go.
I have a question to that. One of the biggest challenges with these kinds of loans is the actual storage. Is the grain stored appropriately? Having warehouses where there's no spoilage, all those kinds of things. Mm-hmm. Did One Acre actually create warehouses and manage them, or was it individual farmer managing?
So that's a great question, and it's definitely an interlinked concern. In this evaluation, villages were provided storage assistance separately. These were all clients that were already working with One Acre Fund, and as part of it, the villages were offered storage assistance. And I think that's a great point. And it also ties into this one, which is another idea of a storage loan. Then that was also accompanied by storage assistance, so rehabilitating areas for storing palm oil. What was interesting here is, again, there was low take-up. This is what I was referencing earlier, and there was actually no impact on overall storage. So people ended up storing it in the areas that were rehabilitated, but it just displaced storage in other areas. And there wasn't a clear indication that the new storage places were any better than the old storage places. So there weren't these, but certainly they're being cognizant of it. They invested in the new storage areas. There also weren't impacts on profits. And one of the reasons why that might have been is it's really hard for these farmers reported that it was really hard for them to break their relationships with traders. They were worried that if they didn't sell right after harvest when the trader wanted to buy because prices were low, that they would destroy that relationship and not be able to negotiate with that trader later on. So I think what's interesting here is you also need to be cognizant of, again, there might be other market failures, and you might not be able to change the seasonalities of selling and buying in one season. It might take time. So I think that's interesting, even though in this particular case it was too bad that it wasn't effective. Okay. This is sort of the last type of credit product that I'm going to dive into before we wrap up. So this is digital financial services. This is a new area. I think it's exciting, and it's an area with not a ton of research, but it's certainly growing. You're all probably familiar with these cutting-edge digital financial services that are emerging among implementing organizations. But the theory is that it has the potential to address a number of different barriers for smallholders. So we talked about the idea that borrowers might not have identification, and so the lender might be nervous about lending to them. But if you have digital financial services with these clear records, then it might make it easier for lenders to assess the riskiness of different borrowers. And we talked a lot about these rural areas driving up administrative costs, and digital financial services also relaxes that. If the terms are better, this could be a great avenue for more affordable credit for investment. And we also, again, touching back on this idea of informal savings and informal lending, digital financial services could be a attractive method for savings in that it is safe, convenient, and potentially can help you hide your savings if you want to do that. This is a neat ongoing project. There's no results, but I just want to share an example of where DFS could go. So this is in Kenya with e-warehousing, and the idea here is that traders will give you a better price if they can buy in bulk. And how does a trader know how much grain is in a village? They don't always, and so they might be reluctant to go to these more remote areas, thinking that I won't be able to buy a lot of grain and it's going to be too costly for me to do that. So the idea here was to help farmers virtually bulk their grain and then communicate with these traders about how much they had and what the quality of the grain was, so that then the trader would come and they could get a better price and they could negotiate on this platform. So farmers were given a cell phone to access this e-warehousing platform. They were also given harvest storage loans in order to be able to negotiate these relationships over a longer period of time. And then again, this is the electronic warehouse I was talking about. So that's where farmers upload, I have this many bags of grain, we'll take pictures of them. There's also these stack checks where people come around and check for the moisture level of the grain and upload that information as well. So there's really real-time data about both the quantity and the quality of the maize that's being stored in a village. And there's also GPS checks on the location of grain, again, to make sure that there's not side selling after it's uploaded, to make sure that it's actually in existence and someone's not just taking a picture of the same bag 12 times, et cetera. And then there's also village-level joint liability on this collateralized grain. So everyone's responsible for everything that goes on the platform. So there's some sort of social pressure to be truthful.
Yeah, so there might be two parts to this question. But
Okay.
The first part, that's still being typed. The
Okay.
first part is in terms of the e-warehouse, like physically where are the grains here? And then the second part is, oh, here we go, is how do you ensure, did they ensure the quality of the grain?
Yeah, so there was storage rehabilitation assistance given out so that farmers could rehabilitate their certain storage places. It's not a requirement that all the grain is taken to one place in the village, but there were, part of the harvest storage loans was intended to help with storage rehabilitation. But really it could just be at various places in the village, and that's part of what this GPS checks is about. So that we know it's in the village, but it doesn't need to necessarily be in one place where you can see it all at one time. And then in terms of the quality, so there were people, as I mentioned, going around measuring the moisture level and assessing the quality, and then relaying that information back into the platform so that the trader was aware of the different characteristics. Private sector run, or? That's a great question. So this is actually just an example of a really, really, I believe, I'm 90% sure that it's just it's sort of almost a proof of concept. So this is something that I believe does not have a existing partner at this time. It was more of a done by the evaluation belief that they built this platform specifically for this evaluation.
I see it implementing the pilot.
Yeah, it's not even a pilot, it's a full random, oh, sorry, we use pilot differently. It's a randomized evaluation, yeah, IPA is.
Yeah, it's a randomized evaluation
Yes.
of a
Yes.
pilot, of
Yeah.
a.
Right, it's not being,
Yeah.
yeah, exactly. Yeah. So this is by a couple different PIs that are, yeah, this is sort of their conception. So I think it is exciting, and there could certainly be, I think there could be a private sector that could step in and take this somewhere. But right now, it's
They must have connections with traders, or how do they attract traders onto that platform?
that's a great question, and I don't know the answer about how they went about recruiting people. The question was, how do you recruit the traders to be on this platform? So there's certainly incentives for the traders, but how do you actually make them come together? And I'm happy to loop back and do some digging and figure out why that is. I don't have the answer to that off the top of my head.
I could also help you. I'm from IPA.
Oh, good.
But I'm new, so I don't know.
I know. We'll do. Yeah, so then, again, so I think there is private sector motivation, and that it addresses farmer liquidity, but it also addresses lender risk, and then, of course, the seasonal price variation is tied up in there, too. One more sort of proof of concept, this is certainly not something a private sector company or lender would ever take up, because, as I'll explain, but this is just the idea of, can savings bonuses encouraging savings behavior among smallholders in combination with digital financial services? So this was just 196 farmers in Mozambique, and they divided them into 4 groups. One of them just got information on fertilizer and mobile money, so sort of introducing them to this concept and then sort of leaving them to their own to take up these different inputs, and as well as mobile money if they so choose. The second one was given information on mobile money and fertilizer, but also giving a savings bonus. So farmers were told that for any money that they put into their mobile money account, they would get a 20% bonus in fertilizer. And that's where the private sector wouldn't fill this. But it is the idea of this is essentially a commitment savings account, and it can actually encourage savings behavior by farmers. Then 2 other interventions were designed to see if these effects would be amplified by social network effects. So in addition to a single farmer getting information on the fertilizer and micro money, they also said, well, tell 2 of your friends, and perhaps then social learning and social network effects will increase take-up. And then that same idea was applied to the 4th treatment group, in which farmers were given mobile money and fertilizer with the 20% savings bonus paid out in fertilizer, and their friends were too. So what happened here is that the savings bonus did increase savings behaviors, because it's essentially like turning down free money if you don't save. So it did increase both the amount of money that farmers put into the accounts, as well as the number of times that they made deposits. So they were more likely to make any deposit. They made more deposits over 3 months. They made deposits of a higher amount by about $1.50 each deposit. And then because they were getting the savings bonus, they were more likely to apply fertilizer as well. This also held true for the social network. So I don't believe that the social network increased the number of transactions further above the savings bonus. But this does get back to these informal borrowing and lending practices. People with access to this mobile money were more likely to, it decreased the informal lending among people. And so there did seem to be some desire to hide resources in a sense from others, and use mobile money as a way to sort of protect that money from these other demands. And I think we could talk a lot about whether that's a positive thing or a negative thing, but that seems to be what people use this for. There we go. Great. So there are definitely some avenues that we need to think about in order to expand digital financial services, and how it can be more scalable and feasible. In some places, there's still a lack of penetration of mobile services and money. And so these particular types of interventions that I just described might be more, at least right now, better suited for places where DFS is already common so that people have some familiarity with using these types of products and using these types of platforms. And as I mentioned, I just shared one ongoing example and one very small pilot that wouldn't really be necessarily scaled up. And so it's definitely an area for more research to come. So just to wrap up, credit constraints do exist, and we've seen, I think, through these examples, how we can get more farmers to borrow, and then we do see that this borrowing can affect agricultural activity. People make more investments, they sometimes switch to higher value crops, and so there's a number of examples here in which farmers change their production decisions based on being offered credit. What we haven't seen is conclusive evidence that this increase to credit affects profits. So there's really mixed evidence across different evaluations, and so that I don't think we've seen this silver bullet of credit increasing profits. I want to go to one last thing as we wrap up, to just talk about why credit might not lead to the increase in profits all the time. And this comes from an evaluation in northern Ghana in which researchers offered an index insurance product, a cash grant to other farmers, and then some farmers got both. So the idea was at the same time we can relax credit constraints, we can also relax risk constraints, and we can see how those two interact. What happened was there were similar impacts on investment across those only offered cash and those only offered insurance. And so what this means that when you gave insurance to farmers, they were able to find credit elsewhere. They didn't need to rely on these outside sources of liquidity, either cash or credit, in order to be able to invest in their farms. They did find credit perhaps from other informal sources that allowed them to change their investment decisions. And so the idea here is maybe credit isn't binding. If what we need to do is relax risk and we see the same outcomes as if we gave someone credit, then it might be that, or it is likely that rather farmers are responding to the risk rather than a lack of ability to invest. Maybe it's too risky to invest given any sort of investment tends to increase income risk for farmers. So this, again, comes back to this idea of there could be room for future research that looks at bundling of index insurance and credit to see whether those two things have interlinked effects when offered together. But risk seems to be an area where we need to think about protecting farmers more than increasing their access to credit. So just to sum up, again, I think we touched on most of this, but I'm happy to dive back into any of the results that we talked about or have more of a conversation in general about anything. Thank you very much.
Thank you.
Any questions, Rebecca?
Not a question, it's a comment. That last point about risk being perhaps a greater, needing greater attention rather than offering more and more opportunities for credit. That's an interesting finding in a way, because I think a lot of what we do tends to be, how can we make credit more easily available and people take it up? But what you're saying there is that, in fact, it's the risk that even if they could get credit, sometimes they won't take it because they see the risk is too great.
Right.
So that that is illuminating, I think, in terms of how one might go about expanding support to farmers and to rural enterprise, being able to manage that risk or to mitigate it somehow. It falls right into, to a large degree, into all the conversations that are going on now about resilience and the concepts that underlie all of approaches taken in resilience team programs.
Yeah, absolutely. And I think it is really, I mean, when you think about what increasing your investment does is you're essentially putting yourself at risk to lose more. If you take out credit to invest more in fertilizer or invest in improved seed, you're really exposing yourself to more risk overall, and you risk losing more. So when you think about it like that, it does make sense. And I certainly think that resilience is important. And hopefully Kyle will come back and talk about that again and just think about Especially as farmers face more and more uncertainty as weather patterns change. What can we do to help make them a little more protected from these uncertainties?
There was an event last fall, maybe, put on by the Bureau of Food Security, and it was about these technology adoption gaps, essentially. We had Microcredit and a few others coming to present on credit risk and one other, I think just general technology adoption. But and one thing they mentioned was kind of the inefficiencies of weather index insurance currently. And so if we're thinking as implementers, we know that credit is insufficient. What kind of insurance option can we work with if we know that the weather index insurance isn't great yet? What do we do in the interim as we're waiting for that to become more efficient?
So I think part of some of the discussion around weather index insurance often looks at sort of the market viability. Like, these were designed to be a market product, but it doesn't seem to be able to pan out that way given that there's low demand and people aren't willing to pay. So I think there's a couple of things one could do to increase demand. One of those is improving or minimizing the basis risk to insurance. So part of the reason why farmers don't like it is that there's always some potential that the payout outcomes of the insurance doesn't actually match up with your actual reality because weather stations are farther away. There's always a chance that weather station is getting different weather than what you're getting. So I think in some senses with the precision agriculture movement happening, there's potentially some room for that to be applied to measuring actual weather outcomes. People, I think, are also thinking about weather index insurance, switching how they think about it to be more about social protection. Not thinking about it as a market product, but thinking about it as a way to protect farmers from these really big uncertainties. And so maybe we need to also think about reframing it because it's not, there's certainly flaws in the product, but there still can be good that comes out of it. And if we think about it as a social protection, a potential avenue for social protection, then I think the bad parts of it where it might result in farmers paying out for something that doesn't actually help them is mitigated. I think there's exciting opportunities around meso-level insurance, so not offering it at the specific farmer level, but ensuring instead cooperatives or other organizations that serve farmers in some way could also be a potential avenue for thinking about how to make index insurance more operable. Those are the things that come to top of mind. Perhaps other people have ideas.
We have projects in Nepal where we are trying to link our target beneficiaries to existing insurance products. There's a livestock insurance and an agricultural sales insurance product. I'm not sure it's an index-based insurance. In any case, the farmers, the uptake on the livestock is good. It's really high, whereas on the crop insurance, not good at all. And one of the reasons is that the value being insured for the crop insurance is the cost of input and not the market value of the product. And that's the issue.
And then what is the payout is for the livestock? It's the value of the...
It's the value of the animal.
Yeah,
which is
makes sense.
Market value. Yeah.
Interesting. Yeah, I think that I don't know a whole lot about livestock-based insurance, but there's an exciting project going on right now, also in Ethiopia, where livestock insurance seems to be working pretty well for people. People are excited about it. People have been getting their payments on time. And I think also...
Where is that happening and who's doing it?
It is being done by the International...
ILRI.
Yeah.
International Livestock Research.
Yeah, but it's called ILBLI. The insurance product is called ILBLI, but it's done by ILRI.
ILRI is based
Yeah.
its global headquarters is in Ethiopia.
Yep. So they're doing it. Andrew Moody is working on it.
And in India as well, livestock insurance has taken off commercially. So, it's really widespread, whereas crop insurance.
Yeah.
And I think there's something that also for, there's certainly social network things also where people are seeing that their livestock insurance is working out and take-up's going to be higher and higher, and Certainly your previous payout experience and your neighbor's payout experience affects your likelihood of taking it up later, unsurprisingly. So.
Examples in the developed world where people are taking out credit without insurance? I guess I think we, in the developing context, we have created these credit offerings, and then sometimes insurance is not bundled with that, as we're talking about, and credit is insufficient by itself. Does that stand, in my mind, if I was going to take out a loan, I'm automatically insured. That those go together. So if we're expecting farmers in these various countries, why do we expect their behavior to be different than how we would?
That's a great point. I don't know of any examples of that.
They have their online crew.
No question. Great. Well, hopefully the next presentation on this and all these questions can be discussed further.
Well, we'll certainly make sure that this whole recorded presentation is online at the FSNet network, and then noted, it's advertised, so that people can follow up and others can look at it and pick up on it as well at a later date. So we may be hearing particularly some of these more innovative approaches and thoughts that you've been expressing might spark some interest in some of our implementing partner colleagues about wanting to know more about how to take some of those on.
Yeah, and we're always here, happy to talk at any time. We want to talk to implementers whenever we can.
I learned several new concepts here. I thought this temporal arbitrage was in addition to being a great name for a rock group, it's also an interesting concept.
Yeah.
What was the paprika one?
Cheetah paprika?
Cheetah paprika, that's another great name.
Cheetah paprika went under.
Oh, bummer.
But of course, 1 acre fund is thriving. So.
Awesome. Thanks so much, Becca.
Thank you.